Where is my little? Someone's supposed to tweet it, but that's okay.
Welcome from Baltusrol.
We're gonna wait for people to find us, but it is July 29th. We're almost at the end of the month, and we're cutting through this tape of the month with a rousing fashion. Now I've seen lots of things like I wouldn't call this the market yet because it's just only been maybe a month, but I've seen a lot of these as the two of my very old colleagues have as well, where if you own index funds, you're kind of getting hurt, or you're really getting hurt because those are really concentrated on the things that are getting hurt the most, and the things that are doing well are the things that aren't huge weights in the index. So you just have this rotation. Someone explained it to me one time as if you think of the world's money as like a bird bath, and there's water in the bird bath, and it just sloshes around. And when it sloshes from one thing to the next, it's ugly and it's sloppy. And it's not. You can't make sense of every little move, but you can make sense of the big moves. And the big move here is people saying, well, this AI trade, maybe we got a little excited, and maybe going to space is exciting, but maybe not that exciting. Where all that money comes out, it has some place to go. So it can sit on the sidelines, but a lot of people who have mandates to invest can't sit on the sidelines for too long. So where do they throw it? They seem to be throwing it a few different places, but let's first mention that they are throwing it lately into healthcare. Why? Well, I'm going to ask my two colleagues that question, why, but I think it's pretty simple. You have large businesses that are generating lots of cash that generally have really good earnings, and guess what? Their balance sheets aren't stretched. They don't have capital needs that are going to be in the $100 billion range. So if you're worried about a lot of different things related to tech and farmland and things like that, and electricity, you might want to look at healthcare. So healthcare has been doing exceptionally well. I'm going to mention at the end some companies that are reporting this coming week to keep an eye on. But maybe Ben, what do you think of that idea of the money sloshing around and that's what's going on? And what do you see happening in the market? Oh, you're muted.
Muted.
Uh-oh. I have to look this way to see him on the monitor, but I'll move that over. All right. Well, while Ben figures that out, I'll ask you, Kevin, what when you by the way, Ben, when you finally
how's that? Is that better?
Now we can hear you. It's not only better, it's actually good.
It works?
Yeah.
No, I don't know if I think about it like as much of sloshing around as it is allocations. So hey, there's no look, healthcare and rate sensitive stuff. Like, we talked about Home Depot. I was like, Home Depot looks okay at the end of May, and like all that stuff. Like, there's just no one who owns it really. So like, if you get just a little bit of money, it trades okay. And then, basically everyone was crowded into one area. But then it's worse than that, because you got to remember, the thing that it's hard to see is the amount of leverage and hidden leverage in the system, right? So double levered ETFs, huge component of what drove the move in semis and move in memory, right? The option leverage, right? Like when you can do a straddle for 7 days and have an implied yield of 125% annualized. Guys sell that's leverage into the system, so you get a trend like we had in Q2, and now it's kind of unwinding, and it very much feels, I don't know, what do you think, David? It felt very blow off to me at the time, and I've been pretty bearish on data centers and the whole picks and shovels thing since, I don't know, late May, early June. What do you think? Was that the blow off?
Yeah, I think so. I mean, I wrote something, I haven't put it out yet, because I just don't know if it's really all that helpful, but I did it for myself. The idea that this is a great market. Like this is, and what I mean by that is, look, I have a lot of index funds, so I'm not happy about losing, or being down. but it's very rational to me. I think what we're seeing is a lot of moves to companies that were left out, like you said, and companies that are ordinarily good companies and that are undervalued relative. Now, are they undervalued? That's a different question. Is the market undervalued, or is it just moving around, or like you said, allocation? I actually think that it's pretty good what we're seeing. It's like a sign of that there is some normalcy.
Yeah,
Kevin, what do you think?
I think that basically the major thing that's gone on also is you got to remember the dispersion traded hedge funds is a big trade where that's why you have an implied correlation at sub 10, which then filters through to why index falls still pretty subdued. For given what's going on in the tech AI trade, to have the index fall at 19 it's pretty muted. Now, whereas NASDAQ falls at 30, right? So the NASDAQ to S&P vol ratio is been at super extremes, but it's still pretty extreme. And so, yeah, I think, David, I wasn't in the game. I started right after the .com. That's kind of what happened during the .com too, where you had the most speculative stocks get knocked out first, and then they kind of like filtered through. And then I guess 9/11 is its own beast because of what happened. But then you had a really ugly year until the summer of 2002. But it was a process. And I think that someone was telling me the Dow to NASDAQ is like going bonkers. And so, that's kind of to your point, right? Secure businesses, maybe they benefit from AI, they're going to be companies that can expand their margins or they can increase their productivity, whatever. And, I don't know, some of the stuff you do, like their business is going to be their business. Like they still make cash flows. They're just under-owned because everybody was putting all their capital into one area. So now maybe it rebalances. And that's what happened then as well.
Yeah. Kevin, what do you think? Is that what's going on?
Yeah, and we talked before the show, I was struck by the move into healthcare, and I knew it was going on, but then when I go through 5,500 charts and I see what's really, I see it all. Here's the State Street Healthcare Select Sector ETF, XLV, and this is Lilly, J&J, and AbbVie is the top three names. So big pharma. And I first saw this and I said, well, that's what you do when you run a market neutral fund. You go buy J&J and you short some things with lousy balance sheets, and you make your money being market neutral. But then I keep going, and it's broader than I think I thought it would be. This is RSPH. I want RSPH, and this is the S&P equal weight healthcare, and it looks the same. And this is Biotechne, Moderna, and Charles River Labs that literally make lab rats. And frankly, equipment looks like this, services looks like this, healthcare services, healthcare real estate looks like this, and even the much maligned managed care sector led by UNH to the downside, even with Humana putting up some lousy news yesterday. It is, that looks like it's getting off the mat. So, and Charlie's groups, the community banks are getting some inflows as well. And I think we know where the outflows. I've got an example that I want to talk with Ben later. But healthcare is, my own psychedelic stocks, the biotechs, and those are working as well. So it's very broad based in healthcare, much broader than I thought it would, when I first started going to the charts.
All right. Well, let's see for how long. I mean, I think this coming week is a big reporting week. This week and next week, very big reporting week. And you've seen UNH, you've seen others just printing whatever they want to print. So I think
take a look at this. This is the monthly on the XLV. That's a 5-year high and an all-time high on this obviously long-term bullish trend. So I mean, it just happened this month. I mean, this is a fresh breakout over the long term. So I think it's pretty substantial.
Well, there we go. We got. I guess Merck is the new Nvidia. So let's just go on to what other hot topics you have here, Ben. And what are you looking at? What are you thinking about?
It's Fed Day. It's Fed Day, buddy. It's and it's a live meeting. You know, it's interesting to see if Warsh is really going to be into this game of live meetings, and I love it. But like, you know, forever we did this forward guidance so that, you know, there just wasn't any, you know, but it was just the ceremonial ringing the bell at that point where the market had already priced the things in. But, you know, we had 2 hikes priced by the end of the year. And I guess I'd say this is that, like, the longer this capex like rollover happens and the market's punishing capex, and, you know, look, the market's been punishing capex by the hyperscaler since last September. That's when this began, right? And you know, and the best way to look at that is just do hyperscaler index divided by S&P, and it's been underperforming for, I don't know, like, what is that, 11 months, 10 months now? And we'll see what Microsoft and Meta say. I think there's whispers that Microsoft would be is the first one to maybe bend the knee. They kind of biffed, if you will, on and they've been treated the worst as well. But the Fed, you know, I think right now is about 1-3 shot of a hike today. And then what will he do with the T-bill purchases? But, you know, I think a hike today could happen. I mean, if he wants to hike, now's the time to hike. But it's always the same thing where it's, you know, always too late. Like the Fed always is doing this. If you remember back to the 90s, after the Asian crisis, we had the long-term capital management and they had cut rates. Well, they had to do another 150 basis points of hikes into the end of that. So I don't think we can come to that much. But if they're dead set on hiking, they should just do it today. You know, what are you going to have a better time? Oil's up. Inflation prints aren't going to be that low for a while. You know, the capex spending, even though the market's starting to see maybe 2028 numbers aren't going to be as rosy as people thought, but it's still happening. The deficit's still 6 to 7%. So, like, right now is the time. If you want to hike,
no. So, but I'll give you a counterpoint to that. Will you do that? Now, just imagine you're the new Fed chair. You've had the last 6 months of pretty much a great time, right? You're high-fiving your friends. You're like, hey, look what I'm doing. And you come in, the first statement was like, hey, we're all getting to know each other. We're going to look at some new data. We're going to try to do some new things. And the day or two before your big talk, the president comes out and says, we should have the lowest interest rates in the world. So you know what happened to the last guy who's still maybe in litigation, may not be with the administration. You know that he's going to pummel you if you raise rates. Are you too afraid? Do you not do anything? Like, is it just a human decision, or do you think it's an actual data-driven decision?
Well, I think also it's easier to raise rates now than it is in the fall, right before the midterms. That has a little more political complication as well. So I guess if you're going to raise, I would do today. Just, I mean, if that's what your mindset is. And let's be clear, most Fed chairs, they come in and they raise. They want to establish credibility. They're a tough guy. You know what I mean? Like, you remember Bernanke, he came in and he was Helicopter Ben, and he proved to be Helicopter Ben, but he did 16 hikes in a row before and you know, basically ran us into the GFC by taking rates to 5.25. Jay Powell came in hot in 2018, and then as soon as he got the green light to hike again, shook that thing up fast, right to 5.25 as well. You know, Volcker came in 10.25, went to 11. You know, these guys do this, and the Fed just, and we talked about my podcast on Sunday, I like to call it the death shot. Throughout time, they do these things, or the last cycle, they pop it. June 2000, they did a 50 basis point. The maestro, you know, rest in peace, Mr. Greenspan, did 50 basis points, and they brought that back down real quick after that. But like, and then did successive. 1929, they did it. Volcker did it. Like, they have a history. Claude Trichet did this in 2011, and he hiked in the summer of 2008. I don't know. The central banks are always a little late. And you got to remember this.
So what's the play, though? Walk through the two different scenarios of what would you do with a hike, what would you do without a hike? If he comes out and says, we're keeping an eye on things, a watchful waiting.
Well, I guess the way I think about it is, there's ways you can trade the meeting. Honestly, like look, it's a $3 of upside for $1 of risk situation, right? Or two to one, I guess. Sorry. At a 1/3 probability. If you wanted to bet on the meeting today, you could isolate that with SOFR futures or options on SOFR. But what I'm saying is, I think you're saying interpret it. What I would say is this: is that if they come in and they hike and they give like the one and done thing, so it'll depend in like a little bit on the language. But if they come in with a hike and it's hawkish, or God forbid a 50 basis point hike, which would be wild, by the way, then market's not going to like it. But here's what I think is: you got to understand the AI capex boom. It's funded by the hyperscalers, but they're almost out of free cash flow. Now they grow, so they'll have a little more room next year. But the private credit sector is what really funds a lot of it, and they fund with SOFR. So like that hurts that, and like you basically have a situation where like when you have the capex booms basically only exceeded by the two railway booms in Britain and in the 1840s, and then the railways in America in the late 19th century. You have savings rates, personal savings rates, like at 2 or 3% in America. There's not much room there, and the deficit's already at 6 or 7% of GDP. So it's not like the government has a lot of room to create an impulse, right? Like they're keeping it together by having that huge deficit. But it's always about the delta, right? So it's like, what's the change? Going from 6 to 10, I'm not sure the bond market likes that. So it's not good. It's not a good situation because asset prices are high and almost all the drivers are kind of in the red. When you push your gas down and the RPMs over there, things are running pretty hot. So, I would just say it's like, it's time to be in the defensives and some of that stuff. I think the market's got it right. I think that like people sneaking over into things that are a little more less loved, more stable, not like trading on hope and a capital market boom that's funded by incrementally, basically.
Kelsey is calling 76% chance of no change today, and a 25% change of a chance of a 1/4% hike. So the market is not ready for a hike at 2:00 this afternoon at all, in my opinion.
Yeah, I'm looking at Bloomberg. It's 1/3 on Bloomberg, like using Fed fund futures.
By the way, who's going to have more views? The Fauci hearing today, or the Fed hearing?
He opted out. He took the Fifth Amendment. He's out. Not a good look.
Yeah, I saw a couple answers. I saw he answered a couple things about a study, but yeah, it's not a good look, and the diaries are bad. But we'll keep the gossip to the three of us would all agree, and then
podcast about that.
Yeah, exactly. That's a different thing. So, what's the last two things you traded, Ben?
The last two things I traded.
I know it's hard.
Well, we basically shorted SpaceX near the high using a 4-to-1 ratio back spread. So like the third or fourth day after the open, and I think everyone knows, like I did a lot of work on the SpaceX. We did like 2 shows and 2 reports. And anyway, I was waiting for the options to open, and I think that was the day that it was at the high. I think we had like 210, 220, somewhere there. And Elon Musk was a trillionaire. And then I bought 4 120 put options for September, with funded by selling 150 put option, and now we're in the money. So you got basically no cost, and if it kept going, you didn't have anything to worry about. Your risk is in that 120 to 150 area. That's where your max like pain could be. So that's worked. We shorted CoreWeave and Nebius and all the data cloud guys, but I haven't really traded too much in the last like couple weeks. This thing's kind of been going. I don't really have like any overwhelming desire to like it's going as I think it's going to go. I don't have when you get something working, you start tinkering around is where you get yourself out of the trade. Is my kind of opinion. I definitely done that for a very long time. I have a long history of doing that, so I try to like run the course. You know what I mean?
Yeah, I agree with that. That's one of the biggest mistakes I think intermediate investors make. Actually, probably all investors make.
All investors, man. I know lots of pros do it also. So like,
that's true. I that's why I corrected myself, because I agree. It's you make some money, then you start to see it slip, and you're like, yeah, this could go all the way back down. or vice versa. You're like, I shorted this and it's going down. Oh wait, it just jumped 3%. It's the turnaround.
Well, I'll just give one last thing and I'll let Kev go. Is my biggest mistakes in my career were like I bought Bitcoin $100, right, and sold that out right before my wedding over a decade ago, like 1,400, and I was like, that was pretty good. I'm gonna pay for the wedding. Where's on the wedding for this and whatever. Or buying Nvidia and Meta in 2022 on that wipeout, like around $120 from Nvidia, like $90 for Meta, and then just like sold them both at 200. Like, so your natural inclination is like, oh, I made some money, and then I'm gonna get out of here. Whereas like a George Soros kind of guy, who, like some of the great traders, as it starts working, they get bigger, right? And that's super counterintuitive to how most humans are wired. Very difficult to do, but like sticking with the trend, or in that case, averaging up. Or averaging down on the short side as well. Although I would argue that the declines are faster than the ascents, and so it's a little bit harder to do that. But yeah, I think that's kind of where you come out at. And you know what the best thing is? The last thing, think about where the terminal value is. Like you're a stock analyst, so you have a view of where it is. Then all you have to do is interpolate the rate of decline. Like, okay, what's the decline rate going to be, the decay curve? And then you're like, okay, over what time period and because then it anchors you kind of roughly like, okay, this is where the washout would be, or this is where the supply would be. Like with silver, in the beginning of the year, there's like a level where it's like, there's no more buyers left. I don't think like anybody is like fundamentally that much different on silver. You just leverage exhausted itself and then ran out of buyers, and now it's 50% less, right?
Yeah. Kevin, what say you? What's on? I saw you gave me a list of names, and you had a few things that you wanted to talk about.
Well, we talked about healthcare, and so that's my shopping list tomorrow and over the weekend, is to find out what I can get through my wife's compliance and what I want to own, if anything. So, but my point there was that healthcare is. I thought it was just let's go hide out in J&J, and I think it's more than that. So that's what I had there. I'm just struck by Nvidia taking out the 200-day moving average as we started the show. It started slicing through, and it's picking up to the downside, and that is becoming adding to this. The SMH is starting to look like a Christmas tree of death. We're not there yet, but it's looking bad. But I put on the docket, especially with Ben on, to talk about CoreWeave, because here we are at 63.34 right now. We were higher when we started this, but look at this. This is the IPO high is 64.62, and then over here at 63.80 is the December low, and we're slicing through that on pretty good volume. So yes, it's down a lot, but I think that this to me is sort of the lightning rod of the AI trade. I mean, this is leveraged data centers beholden to Nvidia chips, and you can see on the monthly how this looks. This isn't much of a support area, going from 33 to 40. The IPO was at 40. And so you got a lot, almost no one's made money on the long side of CoreWeave from in the public market. So I'm just watching it kind of, as we've been talking, pick up and accelerate to the downside and have the volume pick up. So the CoreWeave short is looking really good.
Let me just put a little color on that, because like we got pretty deep on that whole thing, and the CDS is blown out from 465 to like 740 or something, 730. So you've had the bond market, and remember, like CoreWeave, it doesn't need to exist. like these were Ethereum miners that, like, were backed by Magnetar. For everyone who knows who Magnetar is, it's all you need to really know. And they already cashed out like 75% of their fund or their position. Jane Street's out. These guys basically, if the capital markets turn off, they're done. Like, they're done. And no one still knows what the useful life of all these GPUs are. We can all sit here and argue, but let me tell you something. They're not as long-lived as dark fiber or railroads. So, whether they're 4 years or they're 8 years, these guys can't really earn their cost of capital. Like, their cost of capital is probably 11%, and their returns are anywhere from 2 to 6, depending on, a couple assumptions. Over time, David, I know you've done a few EVA, and whatever that thing is, like the net EVA times the amount of capital. Well, when you got to keep adding capital funded with debt and you're not earning your cost of capital, you're just making it worse, right? You're literally just digging your hole for yourself.
Yep. You can't make it up in volume if you're destroying capital. If you're destroying capital, how about stopping? How about doing something completely different?
Hey, we got a negative gross margin business, so we're going to make it up in volume.
Like a Saturday Night Live skit.
Yep. Sorry, Cap. Go ahead.
Kevin?
That's a Saturday Night Live skit that came to mind.
No. He was saying, go take it. Now, what's next?
I've gone through my ideas, and I want to talk about yours.
I'm going to give you a whole bunch of stuff. I'm going to try to do it really fast because there's a lot going on in healthcare. So first, we have Bausch & Lomb reported the stock is down. That should just tell you, sometimes you see what the reaction is. Now, it's trying to come back as people try to support it a little bit. But, if you take a drug from Europe that sells for $20 and you sell it for $1,000 in the US and you can't make money, you got a problem. You have a structural problem. Well, again, this quarter, the company reported a GAAP loss. They'll come out and they'll talk about EBITDA a lot. Why do they want to talk about EBITDA? Well, because they have tons of debt and they want to be like, let's ignore that debt. Let's take away the interest expense that almost mirrors our R&D spending. Think about that. It almost mirrors their R&D spending just on interest. So, look, my views on Bausch & Lomb, both. So Bausch Health, the parent company, reports after the close today at $4.50. That stock is also telling you what. Now, someone asked me this past week, like, why do I still care? Well, it still has a few $1 billion of equity value, and it has an enterprise value much, much larger. So debt holders should care about this, and equity holders who are, I think, bound to get hosed when there's a debt for equity exchange should care about it too. So just keep an eye on that. Thursday, we have Bristol Myers and Amneal, AMRX, and LabCorp reporting. All three should probably have pretty great quarters. Teva reported today. Blowout number, perfect example of what Ben was explaining of like where you just stick with the thesis. The thesis is they're a turnaround. They're putting up good quarters. The stock had dipped before this because they're waiting on an approval for a drug. And so people are like, yeah, well, while I wait for this approval, I'll for a branded drug, do I want to play the quarters? I would, because it's super cheap relative to the rest of the market. So the rest of this week, we have ABBV and Moderna after the close. We have Jazz, a little company called GeneX, WGS is the symbol. Inspire Medical, which is kind of a disaster. So the first two, Jazz and WGS, I actually think are pretty good companies. Inspire, bit of a disaster. I even found a typo, not a typo, on their slide deck, their last slide deck. And I'm going to tell you all this. So they have a compounded annual growth rate chart that is mathematically incorrect. They didn't include 2025. And so they say this, 2020 to 2025 or something like that, but they didn't include that. So it's like way higher. It's overstating. Now, that is an SEC violation. Is it something that they'll get in a lot of trouble for? Probably not. Someone should check their slides. Next week, we have Merck, Pfizer, Amgen, CVS, Lilly, Establishment, some smaller companies late in the week. So those biggies are all going to print whatever they want to print. I think that that the longs in those will probably be rewarded. Pfizer's the wild card in that. Super great yield, but most healthcare hedge funds are like, they're horrible. They don't know what they're doing strategically. They're what's the right word other than they're in trouble. I'll try not to curse, but they're just strategically, they're nowhere. They're late to everything. But then on Thursday, we have Establishment Labs, Cura, Viatris, Z-Lab, all things that I own. So we'll hope for Thursday is a good day. Mm-hmm. Lastly, two things. First, I put in our pro chat that Maine, MANE, has a lockup expiry coming. And it's a pretty big lockup expiry. Let me just get to the numbers, but it's something like 40% of the shares. So tomorrow on the 30th, 14 million shares, 35% come out lockup. And then later, I guess on the 4th or 5th, something like that, a week later, another slug comes due for lockup expiry. In my experience, people who've made 6 times their money on an IPO generally like to sell those types of stocks. So
yes,
in this environment, if you're distributing that to your LPs, the LPs are calling them and saying, where is the wire? Where is the stock? How come this at 10:30 tomorrow morning, they're going to be like, hey, wait a second, I don't see it in my account. Like there's going to be a lot of people who are trying to, I think, head for the exits. One of the things that tells me that the company's aware of this is they put out data a week or so ago, 2 weeks ago, on a study that it's an open label study. For investors who are just learning all the nomenclature, let me tell you what an open label study is. I want to see if something works. So I do a study and I say, I'm going to take a placebo and I'm going to take the drug and I'm going to test it against each other. That's a placebo controlled trial. An open label trial means the doctors know which has the drug and which doesn't have the drug. Now that can skew all sorts of results. And that's why the FDA doesn't really like open label studies, because they're not rigorous really. So keep in mind that. The last I said is HIMSS. Hailey Bieber, there was a whole bunch of data about news about the peptides getting the FDA advisory panel came out and said, yeah, we'll move some peptides from off authorization for doctor supervised application to on doctor supervised. Now that could be really good for HIMSS because HIMSS has a peptide business. And if the FDA makes the final determination that they're going to allow that, because the panel voted for it, now the FDA has to decide. FDA could take a year to decide. Could do it in a few months. Hailey Bieber came out and posted, I love peptides. That was like the first line, I think. I love peptides. Use them for all different sorts of things, for hair and whatever. You can use them orally. You can have them injected, whatever. And I said, hey, listen, we need to be really careful where we get our healthcare advice because, she didn't go to college. I'm not sure she finished high school. She was homeschooled for high school. I couldn't find anything. Now, I'm not saying that someone can't be an expert in peptide science if you didn't go to college. I just don't think I'd take medical advice from Twitter from somebody who is genetically blessed, like no lie, genetically blessed, and be like, oh, peptides are great. Because it's a very convincing argument. But that's what you're going to see if these things do get approved by the FDA for physician supervised things. You're going to see celebrities pushing these untested drugs. And is it great for HIMSS business? Absolutely, if it finally does get approved. Is it what I think bad medicine? 100%. Again, they're not approved for anything. They're just being used for stuff. So that's a kind of a battleground stock. HIMSS here. I do think that the news was very good for them, but the stock is acting appropriately, which is overall pretty good. But let's see what the FDA does. The FDA was against this. they only had one. They have one vote in the entire thing of the panel meeting. But that's healthcare, kind of in a nutshell. Let's go back to watching the Fauci fireworks. I take the fifth.
Yeah.
So.
Yeah.
All right,
do they have RFK in there? Do they bring RFK to just heckle him a little bit, like just from the sideline? You know,
no, they have Rand Paul, and again, depending on your politics, you either view this as a great, like, yeah, people should. This is a big public health thing, and it should be vetted, or you view it as, hey, this is just a political circus, and this is a travesty for America. I've seen the comments on both sides. I've yet to see kind of the middle, which is I really think he was a hero, but I do think he should be held accountable for, especially the diary entries are pretty clear that he was Henry Blodgett got thrown out of the industry for writing things publicly and saying things privately. There has to be accountability for if you're telling people one thing and doing another, if you're in a public health setting or if you're in like the stock market. So, but with a soapbox put away for the day, enjoy the day. We've only started and already it's been a lot of fireworks. So
yeah,
have a great week,
it's red out there. I'm not sure the market's going to be really happy if they hike. Korean market falling apart. The stock's down 4%. It's getting janky.
Wasn't Korea down 10% last night?
Yeah, I think. But the thing about the Korean market is like that thing can open up 7-8, down 7-8. That's just the damn craziest market since Japan in 1989, basically, or maybe the Nasdaq in the late 90s. Like it's a wild one, and it's so concentrated into those two memory names. And one last thing, actually, they had so much leverage that 1 out of 30 adults in Korea were blanked in their margin account with a margin call. So think about that. It's like in America, it's like 10 million Americans brokerage accounts just gone in one day. And they decided, okay, maybe we should get rid of these levered ETFs. That could come to America too. I think that if you want to talk about dragging some guys in front of Congress, I would bet those guys, the ETF complex and the levered ETF complex will find its way in front of Congress if this thing all melts down. And people are like, wait, do we really need, what are we accomplishing here? Because maintaining that leverage on a daily basis, you amplify the ups and you amplify the downs, and it kind of distorts the price signal, you can argue that's not really a good thing, so. Anyway.
I 100% agree. I 100% agree. It's like if sports betting, which I think is an inherently bad idea, but if all of a sudden you decided to sports bet, but you hurt my retirement savings, well, no, I don't like that. So you have people betting on things that they don't know anything about, and when it goes south really, and you hurt my retirement account. Thanks a lot.
Yeah, and if you think about it, it could be in the opposite way too. Like the move up in Q2 in the memory semis names, like with Micron. I mean, it comes out that Micron, these levered ETFs over time were basically vol extraction mechanisms, right? You short one and you long the other, or you short them both. I'm sorry, and then you extract the K. You know what I mean? Like because there's a roll component to it, so they lose anywhere from 8 to, when the vol gets higher, the slippage gets higher. So at a 60 vol, it's a 36% cost to carry to run that position over a year. Now that's credit card debt level, or bad credit card debt, right? And that just doesn't work. And so you could say like, well, I was in this trade, but it got so bid up in the Q2 that I was like, all right, I gotta sell it. And then let's just say this thing, finds a base here. This is speculation. I'm just saying. And then it goes to a new high. Well, you kind of got shook out of it because the price oscillation became larger where you got like, well, it's gone up too much. So it could even be a scenario where you didn't lose money, but you didn't stay in the trade because it front loaded so much of it. So I don't know. I'm not a big fan of them. Let's put it that way.
Yeah, I'm not either. But just remember that the largest ETF companies are like BlackRock, right, and State Street and Vanguard. They may have a call into whoever is the regulator. So
just saying, you could see a situation where if Trump loses midterms, the things turn. They might not be as, I don't know if they're anymore. I mean, I've heard there's like no SEC anymore. Like the amount of grift and like just cutting any kind of regulations that's going on in DC right now is like all timer. That's usually what you see before things go the other way, right? Like, I wasn't alive in the 20s, but I heard in the 1920s, they call it the Roaring 20s for a reason. And then we got a lot of Glass-Steagall, and we got a lot of different things that were the reaction to the excess, if you will, and lack of regulation.
Yeah, I think it's a sign, by the way, of how needed it is if people who make money in the markets who are usually the ones who are like, hey, listen, let the markets be, are the ones, because I completely agree. This would be a common sense protective type of regulation of we don't allow those, or we allow them for institutions only, but I wouldn't even have them for institutions only. I'd just say, look, levered products shouldn't be allowed.
Yeah, look, you can use leverage. Margin debt is not like a problem, right? You can use margin, but the beauty of margin debt is that when the trade works for you, you're delevering, right? And then when it works against you, yeah, you're increasing your leverage, and that's the natural way of things. This idea that you have to rebalance at the end of the day brings in this concept of, well, what's the market liquidity on any given day, right? So you have a liquidity mismatch that drives this, and these algorithms are all running on GPUs, and they're smart, and then they can detect where the flows are coming, then they just lift the buffers, and then it just amplifies it even more in that sense. So it's not good. Let's leave it.
Kevin, any final thoughts?
I like them because when they have a congressional hearing admonishing the aforementioned ETF heads for their leverage products, that's going to be the low. And so I look forward to seeing that and using that as a signal.
I would agree. All right, I got to run.
All right, everybody. Enjoy the rest of the week. And for Wall Street Beats, I'm David Maris, Kevin Bakes Baker, Ben Bry, also known as
Mr. Baltusol.
Mr. Rose. I thought that was a Hyundai symbol.
Great course.
I thought that was
that's one of the great golf courses in New Jersey.
It's gorgeous.
I know. Everybody enjoy the week. Thanks, everybody.
Thanks, John.